Ending the mortgage holidays. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your Stein, because we're going to need it for this one. We're looking at, a recent release from ASIC, the Australian Securities and Investment Commission, regarding expectations for retail lenders and, the end of the loan deferral period, or as I call it, mortgage holidays. Now they've been extended once again until March, and I suspect at March we'll start seeing people pushed either to sell or to go interest only. We'll have to see. It really feels like they're kicking this can down the road. So let's have a look at this to get a bit of an understanding, at least what the ASIC has said regarding the ending of this period, because it is we've seen articles where professionals on six-figure incomes are depending on these mortgage holidays to stay in their home. So this is reducing the chance of forced sales, and it is an extreme intervention in the market. So, ASIC publishes expectations of retail lenders when loan repayment deferrals end. Today, and this was on the 13th, a few days ago, ASIC has published expectations of lenders to assist them to deliver appropriate and fair outcomes to consumers whose 6-month loan repayment deferrals will expire in the coming months. These are added to ASIC's earlier expectations published on the 29th of April 2020. Importantly, ASIC's expectations include how lenders should approach consumers who cannot resume repayments on their mortgages. If a consumer identifies that they cannot resume full repayment on their mortgage, ASIC expects lenders to make reasonable efforts to gather personalized information about the consumer's circumstances. We consider that taking such steps will allow lenders to make a decision about the consumer's loan in a fair and appropriate manner, including better enabling lenders to offer assistance that genuinely meets the needs of each consumer. ASIC is also working closely with APRA to ensure that our expectations of authorized deposit-taking institutions and how they are handling loans impacted by the pandemic are aligned. APRA has issued a consultation letter regarding ADIs, capital measures, and reporting requirements for loans impacted by the pandemic, and an update to its FAQ. ASIC continues to encourage all lenders to work closely with consumers affected by the pandemic to develop solutions that not only provide relief, but are sustainable and assist consumers over the longer term. Now, this all sounds good, but if unemployment's going over 10%, there's no work out there, wages haven't grown, some people are going to have to sell, everyone. So let's have a look at the new expectations. The COVID-19 and financial hardship ASIC's expectations of retail lenders when loan repayment deferrals end. So, in response to COVID-19, lenders offered consumers the ability to defer repayments on their mortgage for a period of up to 6 months. A significant portion of these repayment deferrals will be expiring over coming months. Lenders must do all things necessary to ensure that the credit activities authorized by their license are engaged in effectively, honestly, and fairly. As such, we expect lenders to have processes in place that will allow for an orderly transition and, importantly, deliver consumers appropriate and fair outcomes. We consider that such processes should include the following: contacting consumers about the expiry of their deferrals. Well, we don't want the same debacle with MeBank and their dreadful communication to their customers. Remember that. Number one, lenders should make reasonable effort to contact consumers prior to their repayment deferral expiring. This contact should be timely and allow for consumers to have reasonable time to consider their options. 2. We continue to expect lenders to provide consumers with information that will assist their decision-making in accordance with our earlier expectations. 3. In circumstances where a consumer does not respond to a communication, lenders should try to contact the consumer using a range of communication channels. Lenders should be able to evidence that they have made reasonable efforts to contact consumers. See, they're worried about the current affair effect. ACA. If a consumer cannot resume repayments on their mortgage. 4. If a consumer identifies they cannot resume full repayment on their mortgage, we expect lenders to make reasonable efforts to interact with the consumer directly, for example, via a phone call. We consider that a conversation or other direct interaction with a consumer will allow lenders to gather more personalized information about the consumer's circumstances to make a decision about the consumer's loan in a fair and appropriate manner. Now that seems like common sense, and it's kind of sad that that needs to be put into this type of document, but you can see why. How personalized is your banking service that you're getting, guys? In circumstances where a lender determines that it would be appropriate to offer further assistance to a consumer, lenders' processes should be flexible and empower staff to offer tailored assistance that genuinely addresses the needs of the customer. Lenders should keep records which set out the assistance options they are providing to each individual customer. 6. If a consumer is dissatisfied with a lender's response or actions, lenders must ensure that they comply with the requirements set out in ASIC's Regulatory Guide 165, Internal and External Dispute Resolution. Importantly, in accordance with Section 72 of the National Credit Code, if a consumer notifies a lender that they will be unable to meet their repayment obligations after the expiry of a repayment deferral, and the lender makes a decision to not provide further assistance by way of varying the consumer's credit contract, a consumer must be notified of their rights to complain to the Australian Financial Complaints Authority. In circumstances where a consumer's repayment deferral expires and they miss a repayment, lenders should make reasonable efforts to contact the consumer and assess the appropriateness of further assistance being offered to them. Lenders should have in place processes that are easy for consumers to understand and navigate. While these expectations are focused on how lenders should manage the expiry of repayment deferrals on mortgages, we also expect lenders to consider these expectations more broadly while responding to consumers experiencing financial difficulty due to the pandemic across other credit products and assistance arrangements. That's it. There's hardly any discussion of credit cards. How crazy would they be? ASIC is closely monitoring how lenders are assisting customers experiencing financial difficulties due to the pandemic. As part of our monitoring activity, we have been meeting with a range of lenders, including ADIs and non-ADIs, based on this engagement. To help consumers make informed decisions, we think more can be done by lenders to provide consumers with personalized information or representative examples about how assistance arrangements may affect their repayments and the cost of their loan over the long term. We think this is important for lenders to consider in the context of providing consumers with further assistance at the expiry of a repayment deferral. Some lenders have raised queries with ASIC about how to approach situations where they identify that a consumer's financial difficulties are so severe they will not be able to repay their loan over the long term. ASIC expects lenders to make all reasonable efforts to work with consumers to keep them in their homes if that is in their best interest. ASIC recognizes that there will likely be some circumstances where offering a consumer further temporary assistance may make their situation worse. Such situations will need to be carefully identified by lenders and involve a high level of engagement with those affected consumers. Many lenders have informed us that they are regularly reviewing and reassessing their approach to consumer engagement. For example, incorporating consumer feedback into consumer communications. We encourage all lenders to build continuous improvements into their processes, as this will likely result in better consumer experiences and outcomes. We continue to encourage all lenders to work closely with their consumers to develop solutions that not only provide consumers with relief, but are sustainable and can assist consumers over the long term. It also remains important that lenders continue to ensure that information about assistance is relevant, accessible, and available to all consumers. ASIC is working closely with APRA to ensure that our expectations of authorized deposit-taking institutions and how they are handling loans impacted by the pandemic are aligned. APRA has issued a consultation letter regarding ADI capital measures and reporting requirements for loans impacted by the pandemic and an update to its FAQ. So what we can do is let's jump here and have a look at this letter from APRA to see what they're saying to authorized deposit-taking institutions. So consultation on termination of loans impacted by COVID-19. To help facilitate authorized deposit-taking institutions, ADIs, supporting their customers through the COVID-19 period, APRA announced in March a temporary capital treatment for a period of up to 6 months for loans where the ADI has granted a repayment deferral. On the 9th of July 2020, APRA published a letter which extended the temporary capital treatment and also adjusted the treatment of restructured loans affected by the pandemic. As foreshadowed in the letter, APRA intends to formalize the announced capital measures and reporting requirements through temporary legislative instruments. APRA will give effect to the temporary capital treatment by adding a new attachment E to Prudential Standards APS 2020 credit quality. The new attachment E will operate on a time-limited basis and modifies the application of APS 2020 requirements for loans affected by COVID-19. A draft is included in attachment A to this letter. APRA's July letter also highlights the importance of public transparency regarding the extent and nature of loans granted repayment deferrals or that have otherwise been restructured. APRA intends to collect and publish entity-level data on these loans through a new reporting standard, ARS 923.2 repayment deferrals. Further details are outlined in attachment B to this letter. APRA invites feedback on the draft attachment E to APS 2020 draft ARS 923.2 and its approach to publishing entity-level data, which will be subject to a 1-week public consultation. Written submissions can be made by the 21st of August. If you're interested, there's still time. So, attachment A. The contents which follows will be included in a new attachment E to the currently enforced 2015 version of APS 2020. Attachment E, COVID-19 adjustments. Notwithstanding any other requirements in this prudential standard, a COVID-19 loan as defined in paragraph 2 is subject to the provisions in this attachment for the period of 23rd of March 2020 to the 31st of March 2021. Scope. To a COVID-19 loan refers to a credit exposure that meets all of the following criteria. So what's a COVID-19 loan? Let's have a look. The loan is provided to an eligible borrower. An eligible borrower for this purpose is either a natural person or a small to medium-sized enterprise with less than 10 million in total debt facilities outstanding. The borrower's ability to repay, according to the original loan term, has been affected by the pandemic. And B, the loan was not 90 days past due or impaired at the time a loan deferral or restructure was provided to the borrower. So the examples that we were looking at here, the people in arrears, I mean, look at how many were over 100. So all of these people, none of these people here in Queensland, New South Wales, or WA would be considered a COVID-19 loan if they were already 90 days past due. Interesting. So repayment deferrals. When an ADI provides an eligible borrower with an eligible repayment deferral, the period of deferral does not need to be treated as a period of arrears for prudential purposes, nor do the loans need to be regarded as impaired. An ADI may pause the counting of days past due from the date at which repayment deferral is granted. This temporary capital treatment is available until the earlier of either A, an aggregate period of 10 months from when the initial repayment deferral was granted, or the 31st of March 2021. So we're not going to see... So none of these ones are going to be tracked as in arrears. Interesting. For the avoidance of doubt, this temporary capital limit ends on the 1st of April 2021 for all loans, irrespective of when the repayment deferral was initially granted or the period remaining on the deferral. For the purpose of paragraph 3 of this attachment, an eligible repayment deferral means A, a repayment deferral for an aggregate period of up to 6 months that was granted to an eligible borrower prior to the 30th of September 2020, or B, a repayment deferral granted in accordance with subparagraph 4A that has been extended beyond the initial 6-month term, or a repayment deferral that was granted to an eligible borrower after the 30th of September 2020, where the ADI has conducted an appropriate credit assessment of the borrower. As part of this credit assessment, the ADI must be satisfied that the borrower has a reasonable prospect of being able to repay the loan on appropriate terms at the end of the deferral period. For all other COVID-19 loans that have been granted an eligible repayment deferral, an ADI must resume the counting of arrears for prudential purposes at the end of the deferral period and for the number of days past due at the time the initial deferral was granted, unless the loan is modified in accordance with paragraph 8 of this attachment. Notwithstanding the other provisions in this attachment, when an ADI determines that a loan is impaired or the borrower is unlikely to pay in accordance with the criteria detailed in paragraph 26 of this prudential standard or paragraph 77 of attachment A to Prudential Standard APS 113 Capital Adequacy Internal Ratings Based Approach to Credit Risk. It must treat the loan as impaired or defaulted unless the loan is modified in accordance with paragraph 8. I need a shot of coffee, guys, if I'm keep going with this one. Restructured loans. For the purpose of this prudential standard, a deferral period extension of mutual or capitalization of interest that results solely from implementing an eligibility repayment deferral is not a restructure. 8. Where an ADI otherwise modifies or restructures a COVID-19 loan as described in paragraph 27 of attachment A to this prudential standard before the 1st of April 2021, the ADI does not need to treat the loan as impaired following the restructure where all of the following criteria are satisfied. The ADI and the borrower have formally agreed to the modified terms. The ADI expects the borrower will perform in accordance with the modified terms so that the ADI will receive in a timely manner the full amount of modified cash flows contracted to be received. C. No repayment deferral periods are provided to the borrower as part of the modified terms. And D. The loan has not been returned to a non-impaired status under the paragraph more than one time. An ADI must reset the counting of arrears to 0 for loans modified or restructured in accordance with this paragraph from the date of the restructure. Where an ADI restructures a COVID-19 loan and the restructure does not meet the criteria in paragraph 8 of this attachment, the loan must satisfy the conditions in paragraph 34 of attachment A of the prudential standard before it may be returned to a non-impaired status. So other clarifications. For the avoidance of doubt, a COVID-19 loan that is subject to an eligible repayment deferral or that has been restructured in accordance with paragraph 8 of this attachment does not need to be treated as 90 days past due or impaired for the purpose of Prudential Standards APS 112 Capital Adequacy Standardized Approach to Credit Risk or APS 113. For the avoidance of doubt, a COVID-19 loan that has been restructured in accordance with paragraph 8 does not need to have performed in accordance with the modified terms and conditions of a period for at least 6 months prior to being re-rated to a non-defaulted grade. Okay, so that's interesting. You can instantly get right back. For the avoidance of doubt, a COVID-19 loan that is subject to an eligible repayment deferral or has been restructured in accordance with paragraph 8 of this attachment may be considered a performing loan for the purpose of calculating the ADI's required stable funding requirements. Learning something new every day. So, attachment B, the entity level publications. As previously communicated by APRA, the transparency is an important component of the capital concessions provided to ADIs. To promote this objective, APRA intends to collect and publish entity level data on COVID-19 impacted loans through a new reporting standard, ARS 923.2 repayment deferrals. The APRA intends publishing data at an entity level for those ADIs that have total loans subject to repayment deferrals of more than 10 million and total number of facilities subject to repayment deferrals greater than 20. APRA expects that data collected under ARS 923.2 will be non-confidential. However, in order to protect borrowers' privacy, APRA will not publish data that represents a small number of loans. In its publication of the data, APRA will continue to highlight that the temporary repayments deferral programs were implemented within tight timeframes and the data has been submitted to APRA on the best endeavors basis and may be subject to revision. The first publication of ARS 932.2 data is expected to be in early September 2020. This publication will cover COVID-19 impacted loans for individual ADIs as of the 30th of June 2020 and the 31st of July 2020. The APRA publications are not a substitute for appropriate disclosure by individual ADIs. Going forward, APRA expects that ADIs will provide the relevant data within 10 business days after the end of the reporting period to which the information relates. APRA then intends to publish the data at the end of the month to which the information relates. APRA will also notify ADIs 24 hours prior to the release of the publication. This will allow, with tight timeframes and opportunities for ADIs to disclose initial information if relevant. The table below sets out the reporting data that APRA intends to include of its entities. So the value and number of deferrals split by housing and SMEs, new loan deferrals granted during the period, and risk indicators, interest only, investor, and high loan to value ratios. So there we have it, everyone. An insight into, well, the ending of the mortgage holidays, ASIC's expectations, and APRA's requirements. What do you think? Do you think they'll kick the can down the road even further? And how will this affect the beginning of forced sales that we're starting to see? Those taps on the shoulders. As always, let me know your thoughts and opinions in the comments down below. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join the channel on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy our merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day, and I will see you all in the next episode.